Hi, I'm Sam Brotman. I want to talk to you today about corporate holding companies. Now, what is a corporate holding company? So, if you've watched my previous videos, I draw two circles on a piece of paper. The left circle represents your enterprise. It's your business, it's your real estate holdings, it's your investments, it's all the ways that you make income. And then the right circle represents you or your family. Income will pass through your enterprise. There will be expenses associated with the production of that income, and ultimately, you're going to have a profit. From there, how much profit needs to pass between the enterprise and the family so that the family lives the way it wants to live? So, in looking at this analysis, what a lot of people are doing is a lot of people are moving corporate profits into the family side of the equation in order to facilitate other investments. And the problem with that is everything that gets moved over from the corporate side to the individual side is taxed at individual income tax rates. Individual income tax rates are anywhere between 37 and 39% at the federal level, not factoring in any state tax consequences. In comparison, corporate tax rates are 21%. So initially what we're talking about here is we're talking about anywhere between a 16 to 18% benefit by leaving profits within the corporate structure. Now, I know what you're saying. You're saying, Sam, I don't want to just let a bunch of profits sit there. I want to make other investments. I want to do other things with my money. I want to put it to productive use. This is where the concept of a corporate holding company comes in. So if I had a business and the business generated $1 million in profit, and I didn't need that $1 million to run my business, I could distribute it to myself as an individual, paying 37 to 39% in tax, or I could flow that money up into a corporate holding company, receiving what's called a dividends received deduction at 100% and preserve my 21% tax rate. So the same $1 million is being taxed at a much less tax rate. From there, the corporate holding company is now holding the remainder, the $1 million post any taxes. And that corporate holding company can take that money and flow it into other investments. It can either hold passive investments through the holding company directly, or it can hold active investments like other businesses or other real estate ventures through subsidiary entities. So essentially what happens is you think about it this way. The corporate holding company sits as the head of the octopus. As one tentacle starts generating cash, it flows up into the head, and then the head distributes it down into other tentacles, which create more cash. As those tentacles create cash, they flow it back up into the holding company, and the business owner just adds more tentacles or more investments, preserving the 21% tax rate as you go through this structure. Now, your CPA might freak out about this a little bit because they'll say, well, you need to make a dividend. And the question that I would have is, why? Why not leave your wealth in an asset-protected holding company structure where you can accumulate wealth much faster? Why? Because you're paying less taxes. So, as you build this structure, the structure serves as a proxy for you, but a much more tax efficient and liability efficient structure. Human beings are terrible holding companies because they create lots of liability. If you own things in your individual name personally, and you're driving down the street in your car, you're putting all of your assets at risk. So not just from a tax perspective, but from an asset protection perspective, a holding company may make sense for you.